4826000 Taiwan 00. 15% 25% 60%. /CH. N. Good morning everyone, and welcome to our market analysis. Global markets closed last Friday showing clear signs of fragility. All three major U.S. indices ended the session more than 1% lower, with the Nasdaq Composite closing at 26,225.14, the S&P 500 at 7,408.50, and the Dow Jones Industrial Average at 49,526.11. The VIX Volatility Index, often seen as a fear gauge, climbed to 18.43, and the 10-year U.S. Treasury yield surged to 4.59%. This confluence of factors strongly indicates a significant increase in risk aversion among investors, putting systemic selling pressure on risk assets. Therefore, our primary direction for today is focused on risk control and defense, with an 80% probability. We are observing capital actively withdrawing from high-valuation technology and growth sectors, flowing instead into areas like energy, which are positively correlated with geopolitical risks, and into the US dollar as a traditional safe haven. Looking at the global capital flow, the significant sell-off in US equities on Friday, coupled with Asian markets, particularly A-shares, following suit this morning with the CSI 300 index down 1.12% and the Shanghai Composite down 1.02%, has created a negative feedback loop. This global risk aversion sentiment is expected to persist until the U.S. market opens, suppressing any pre-market rebound attempts, with a 75% probability of continuation. Breaking down the macroeconomic drivers, we see multiple bearish factors converging. First, interest rates. The 10-year U.S. Treasury yield at a high 4.59% directly suppresses growth stock valuations and increases overall economic financing costs, posing a clear negative impact on risk assets with an 85% bearish probability. Second, the U.S. dollar index DXY, trading at a high of 99.27, signifies a strong dollar which tightens global liquidity and puts pressure on emerging markets and U.S. multinational corporations' earnings, with a 75% bearish probability. Inflation remains a concern, with U.S. April CPI year-over-year at 3.8% persistently above expectations, compounded by Middle East conflicts pushing WTI crude oil prices to $101.02. This reinforces market expectations for central banks to maintain restrictive policies, carrying a 90% bearish probability. Finally, geopolitical risks. Iran-related tensions introduce uncertainty, directly pushing up energy costs, exacerbating inflation fears, and generally eroding investor risk appetite, with an 80% bearish probability. Turning to core assets, U.S. equities are set for continued downward pressure, a 75% probability. Under the dual suppression of the 10-year U.S. Treasury yield at 4.59% and the VIX index above 18, the technology-heavy Nasdaq Composite, which closed at 26,225.14, will likely test the critical psychological support level of 26,000 points. A-shares are showing domestically driven risk aversion. Following the global risk asset sell-off, A-shares have declined, indicating a lack of domestic confidence and reduced foreign investment interest, leading to a generally pessimistic market sentiment. Bitcoin, despite a small rebound to $78,224.53, remains a high beta risk asset in the current risk-off environment. Should U.S. equities continue to fall, Bitcoin will likely face selling pressure, making it an important indicator for liquidity turning points. In commodities, WTI crude oil prices are holding firm at $101.02, suggesting its price is primarily driven by supply-side geopolitical risks rather than demand. Gold, at $4,561.90, sees its safe haven appeal temporarily suppressed by sensitivity to high interest rates, performing relatively weaker than oil. The capital mainlines are quite clear. First,